Depends on what my risk is. But just in case I do, you're going to bear with me. I'm going to go back to the beginning and just do the disclaimers. All right. The sessions for educational purposes only. Any recommendation of the sphere of education, not investment advice. The intent of the video is to demonstrate tools of top-down analysis and how I apply them. This today will include how I look at options and my unusual, deranged approach to trading them. Options are considered very risky by the powers that be. Do not trade options unless you know how to trade them. Get educated. Go to the Options Industry Council for information and things that can save you. Trading involves risk. You are solely responsible. I may own, intend to buy or sell any stock mentioned in the report. Again, trading stocks and options are risky. Consult your advisors before making trades. And we'll talk about various tools today. Now let me fast forward to where I want to be. I think it was like 106. All right. Stocks versus options. I like to enter trades as options because I can control a lot of shares with an option. And if I'm right and I make money, I can sell the options, either put the money in the bank, roll the options up and out, meaning higher strike price and later um, expiration date, and put money in the bank. But stocks have a big advantage. Options are very fluid. And a $10 move in a stock that's $100 is a 10% move. It's probably a 100% move against you or for you in an option, which is good and bad. Options expire over time. Stocks do not. A cheap stock, it's not worth buying options. Some of the stocks where the volatility is so high, it's difficult to buy options unless you buy a spread that allows you to spread out the volatility to the other side. What are the other things I was going to say about that? Watch your position size on options, and you will notice that none of the option trades that I will tell you that I take will hurt me. Now, how is that possible? How could I show you option trades that won't hurt me? Because I said it 2.5 hours ago. I want to buy option spreads that cost me a little bit of money, that have massive upside and controlled limited downside. If I have controlled limited downside, it can't break my account. If I buy a stock and I'm willing to take a 6 to 8% risk on a stop, and that stock is $100, if I can buy a call close to the money for $2 or $3, I have less risk if it goes to zero than if the stock hits my stop. So I 100% agree with the Options Industry Council and all the societies that tell you be careful. And the reason you be careful is this. I am going to show you a synthetic trade today. It's not the trade I will take. I take the chicken shit synthetic. But I'll show you that the synthetic trade looks just like buying the stock, and you pay pennies or get paid pennies. When you're not paying much and you're young and dumb and whatever, you may make a mistake and buy too much. And that's where options, I think, can kill you, is if you don't watch your position size, because they can go against you. So let's talk about it. So first I looked at it, I said, boy, this has been my favorite stock this year. It's now trading back to this after, well, let's just look at it. I think I said this in one of my videos. Somebody asked me at dinner, we had a board dinner at the beginning of December, and the stock was in the 90s. I remember first. And they asked me, one of my board members, what is your stock recommendation? Too many letters. And let me try that again. So this is going to narrow it, but it doesn't just give me the one I want. So I'm just going to look at alphabet. And I said, so I'm back in December, and I said, right around, I guess in here, I said my stock, it was 90 something. So it was in this range right here. And I said my stock of the year pick is SE. It was the end of November. And I said, this is the stock if I had to pick one. Of course, it went up. So did a lot of things. But this is what happens if you're not careful. The stocks break down. Now it's running again. It's back close to all-time highs. So it's certainly not the one that I'm going to pick to work up to buy tomorrow because, well, I don't want to give you something that's going to go down hard and I'm going to look like an idiot. And this thing I had has earnings coming up, and I'd rather buy something that I think has a more likelihood of going up. It's not extended. So I picked Royal Caribbean. Uptrend, massive pullback with the market breaking out now. Did not like the tariffs because we're going to stop traveling. We're going into a depression, recession. And if you think about, sorry for the drinking noises, my mouth got dry. All the bad things that happened this week with GDP, um, the market was up on the week. So I like Royal Caribbean. I liked it more maybe a few days ago. But I would be interested in buying Royal Caribbean. High-low jump is fine. I'm seeing a constellation of all blue dots here. Um, this thing here, the red candle high would have been this. It pulled back one day, but it's already running again. Relative strength clearly above the moving average as is volume. No, I don't like the fact that the weekly bongo has not turned yet. Remember I said after a big sell-off, it might take a while for all the bongos to go the right direction. So this is the stock, and I'm going to buy it around 230. So I'm going to set my strike price for the options at 230. These are all the option spreads that I was considering. And you'll have this slide. So it's got a couple of different, a 10 wide and a 20 wide bull call spread, a 20 wide and a 10 wide bull put spread. It's got two variations of a call ratio back spread. It's got a covered call. It's got a butterfly, and then I'll show you two better butterflies. It's got a long call, long stock, short put, and synthetic long stock. Remember, this is when you're not going to buy because of the risk. Unfortunately, I haven't figured out how to build my own spreads into this program, and therefore I'll show you them graphically, but they're not going to be in the spread maker. This has the strike prices, whether it's a call or a put, whether I'm long or I'm short, the prices at the close on Friday. You can see the bid and the asks are relatively close here. That's why I decided RCL, not the others. And Mike Valencia knows that's where this gets dangerous if I don't do that. You can see the open interest is enough that I wasn't too worried. We're not going to talk about the Greeks because, frankly, I don't speak Greek. Probability of finishing in the money, break even up, breaking down. This is how much the stock has to move to break even. This is the maximum risk I'm taking. You see these two to control 100 shares. I don't want that much risk. That's why these are not the trades I'm going to take. The bottom three, rather. Maximum profits. I like INF. I won't lie. Credit debit, the least I have to pay, the best, and this is to control 100 shares. And this ranges between $1,300 of a covered call. Long stock is $1,317. As you could see, I don't know why the covered call is that much. Something's silly. I'd have to go figure that one out. Buying it at 100 shares at 229. Oh, that's profits. Credit, debit. Oh, I don't understand some of that, but we'll look at it on the individual trade. So this is a spread maker. I want things that have infinite upside, and I want controlled downside. Do you see on this list some things that have infinite upside and numbers that you can live with to the downside? I do. Now let's look at the trades. This was created yesterday for me to think about Monday. This is not an example from the past. This is a P&L curve. If I wanted to buy 100 shares, and that's hard to see, but it's $22,995. I'm not poor, but how many hundreds can I buy or you buy of a $229 stock? Remember, 230 was sort of, if it goes above 230, it triggers my buy. All right, so 100. Now, if I own the stock, you see this dashed line? You see this dashed line is set at equal to the right, equal to the left. Doesn't mean it's equal upside, equal downside. It just says that my break-even point doesn't require it to move to the left or to the right. If it goes up a penny, I make a penny. If it goes down a penny, I lose a penny. So this here, the blue line is your P&L curve. To the right is time, is price point here. So as the price goes up, your profit goes up. As the price goes down, your profit goes down. So you're paying $23,000 to control 100 shares. Your maximum profits are infinity and beyond. Your maximum risk is you could lose it all. Well, no one's going to lose it all because you're going to put a stop in. But a 6% stop on 23,000 is probably 6, 12, $1,300, give or take, or more. I'm doing math on the fly isn't always my strength. So the advantages, all the upside, easy to figure out. You have the downside, you could stop it. You don't have to own an option. All right. If you buy a call, you get infinite upside. You have controlled downside. So I'm buying a call at the 230 strike, a June expiration, and I'm going to pay $13. So for me to make money in the between now and the expiration date, it's going to have to move $13 for this line to cross above zero. That's the downside of this call. It's a lot cheaper than the stock, but if the stock moves $10, my call's worthless. Well, my call's worth $10, but I paid 13, so I'm negative. If it goes down, I have maximum loss. So as it goes up, I reduce my loss, but I'm still negative till it moves $13. So it's not a bad trade. I'm paying $1,317, infinite profits, the most I can lose, but it's got to move $13 to break in. So I'm going to just write this down here. Call 1317. It's got to move $13 to make a money, infinite beyond. Nothing wrong with that trade. And for, this, by the way, is what you pay for it. So you can't lose any more than what you pay for it. A spread. A spread says, you know what? I'm willing to bet that it's going to go up, but it's not going to go up that much. So I am going to sell a 250 call. I'm going to buy a 230 call. Instead of costing me $13, it's going to cost me 13 minus 5, $8. So now it only has to move $8 for me to win. Now, on a vertical call spread, the most I can lose is the $8. So my price to pay went from $1,317 to $800. I only have to move $8 to win, but the most I can win is the strike prices are 20 apart minus the 8 is 12 bucks. High probability trade. Um, Netting out 12 against spending 8. That's not a bad return. That's 150% on my money, but that's boring. I like infinity. Safe trade. It reduces my cost. If you have to build confidence and courage, you've been burned a few times, you want to do spreads because the spread reduces your cost. Is this unlimited risk that you need to be nervous? Absolutely not. What about a butterfly? Imagine you're in a plane, and this here is the landing zone. And if you land anywhere outside the landing zone, you die. And this landing zone is about 10 feet, and you're at 30,000 feet in the air. How confident are you that you're going to stick the landing? It should be about the same confidence as making any money on this trade. This trade says, I want to buy that 220 call, which is already 10 bucks in the money because the stock is 230. Woohoo! I'm going to sell the 230 call, but I'm going to sell it twice. That's going to give me 2 times 13, 26, which means I have 7 bucks left over after buying the long call, and then to protect myself, I buy another call on the other side. Now, I like selling this one because that parachutist, 90 out of 100 times, is going to fall into the ocean and die. And when you take this trade, I think your likelihood of winning is pretty low because you got to be exactly within 220 and 240. What would kill me before I figured out how the game worked is I'd do a butterfly and the stock would go this far. I was right on the stock, the direction, the time. I picked the wrong spread. X. I don't buy these. I sell these. But just for the sake of what we've been looking at, it's cheap, 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 cheap. For $1.25, you controlled a share of stock. The most you can lose on this trade is $1.25. The most you can win is 200 and well, it's $125 for 100, but is $2.38 or 238 100. This is not a good trade as far as I'm concerned. You've got capped upside for no downside. But I do really like the idea that I'm selling something to reduce my cost of entry. Here's 2 better butterflies, and I apologize it's hard to see them. So it's all right, I'll build them. It's faster to do it what I was doing, but I can build it. So here is a bad butterfly in my mind, unless I'm selling it. But let's be honest. How much do I like getting paid $1.25? Excuse me. Yes, and risking $8.75. I don't like that. So I don't really do this trade either way. So let's take this butterfly, and I'm bullish on Royal Caribbean. I think it's going to $300 in the next month. So what I could do is edit my spread. Let's leave it at 220. Let's take this thing up to maybe 280. That's 60. We got to take this up to 250. And all I did was create a butterfly with a longer landing zone. But I also made it much more expensive. I'm now paying 10 bucks to get a $50 landing zone. Um, I mean, it's better. Again, to buy the call, it was costing me $13.17. To buy this spread, it's costing me $9. So it's a lot cheaper. The most I can risk is what I paid for it. It's a long option. But what if it goes to 300? I'm an idiot. All right, how do I fix that? I can fix it. And there's lots of different ways to fix it. But what I'm going to do is I'm going to make this more expensive. I am going to bring this 250 to 280. I'm going to take this 280 to 300. And this might be too expensive, but watch what it does to the curve. Yeah, there's still a sweet spot where I have a maximum win. Okay? I've now put a $17 cost to it. So you could ask whether I'm better off buying a call. All right, and I might be because I have unlimited upside. But this is another variation of the trade. It's a butterfly in putting it together, and maybe I went too aggressive and I could make it narrower and get it to $13. I'm sure if I edited it and I took the 280 down to 260 and I took this down to 280, what did that do to the cost? Took it down to $14. So now, for the same price as a call, again, do I want to do this? I don't know. And this is where I start looking at each of these and I look at the price compared to the call. But from a construction perspective, I still got a positive if the market goes up. If I trade beyond that typical butterfly area, I still make money up here. So these can either be a wider or what's called a broken wing. And it does, this is a butterfly's wings, and here the wing is screwed up. But I like this screwed up wing because I really hate it when I'm correct on the name, the time, the direction, but I bought the wrong spread and I don't make any money. Ratio back spreads. Now we got something that I underutilize. And every time I do these events, I think to myself, you got to use them more. You got to use them more. I'm selling one at 230. I'm buying two at 240. Now, this is a cool trade. I have fixed my risk. I fixed my risk at 1,397 for 100 or $13.97 per share. On a $236 stock, that is less than 6%, which is what I was willing to risk on my stop. And oh, by the way, no one says you have to hold it until expiration, so you don't have to take maximum loss. But what I love about this trade is I've got unlimited upside. Now, the cost to enter is cheap. It's only $4. My risk, though, is the $13. Why is it $13 a risk? Because between 230 and 240, if it went out at 240, I lose $10 on the spread plus the $3.97 to go in. If it goes down hard, and I'm in one of these now that just blew up on earnings and it's sitting over here, all I'm out is my 397. So just like with the butterfly, I have a skinny area where it's bad, but once I get above that area and I've traded enough to cover that 10 bucks, that's why it's 253, which is the next $10 and the cost of getting in, give or take. It's infinite gain. Or if I don't want to spend any money, I'll go to a 1 to 3. Or if I want more on the outside. So I'll spend more money. I'll spend $12.30, which is less than buying the call for $13. And once I get through the pain area, I control twice the number of shares as it goes higher. So this becomes a trade that getting in is the same cost as buying the call, but you control twice as many shares because you're getting two calls that are left after one of your buys knocks out the sell. The place you get hammered is there's a period of time where you can lose the 10 bucks, and that's where the maximum risk is. But if you've got conviction and you get up here, you've got two shares, not one share. I like ratio back spreads. We're almost done. Told you it's 3 hours of craziness. And if we take out the break, I got 4 more minutes to get there. This is the synthetic. When I was young and dumb, I bought a synthetic Amazon at 450. A week later it was over 500. I thought I was the smartest person in the world. I bought 40 contracts. This thing could have gone from 450 to 300. I would have broke my account. I was dumb. That's why we'll never take this trade with scale again. You might say, but Jeff, it's the exact same P&L curve of buying the stock. It is. I'm buying a call and selling a put. It cost me 55 cents to control a share here of a $160 stock. Of a $230 stock. Never mind, ignore this. It's costing me 55 cents to control a share of 230. But boy, if you take this trade, you better be in your charts, watching your tickers all day long, because you can get killed. But let me tell you a little secret. It's no different than buying the stock. You manage it on a daily chart. You put your stops in, and you sell the synthetic if you hit your stop. Where you get dangerous is when you're an idiot like I was and say, gee, do I want to spend, buy 4,000 shares of a $450 stock? Let's just do the simple math on that. All right? And you tell me how stupid I was, because my wife would kill me if she knew. That is $1.8 million of Amazon that I bought. All right? If I went down 20%, that was a $360,000 loss on one trade. But I went up. And it kept going higher. I sold my Amazon that I bought at $450 at $3,800, and I bought the house that Praveen and I are sitting in. Now, I sold shares along the way. I sold calls along the way, and then I sold a big tranche to pay for the house. But I eventually switched it to stock. So what was great was the trade. What was stupid was my money management. I took too much risk. This is the trade I take today. This is my chicken synthetic. Why do I recommend this trade? I love this trade. I love this trade. I love this trade. Does it have infinite upside? It does. How much does it have to move? The call had to move $8. All right. This one has to move about the same, maybe $10. Okay. The call, the maximum loss was what I paid, which was $13. Here, my maximum loss is $9. So, less costly than a call, unlimited gains. All I can lose is what I paid for it, which is less costly than a call. This is a synthetic call. I shouldn't call it a chicken shit synthetic. I should call it what it is. It's a synthetic call. I am buying a 230 call. I am selling a 230 put. The difference is about 50 cents that I'm paying. And then I am buying insurance. I'm paying $8.50. So I don't have to go to my wife and tell her we need to move to a smaller house and I have to sell my boat. And so I can sleep at night. I like this trade. This is probably the trade I'm going to put in on Sunday night. And the way I take the trade is, one, I'm only in if it goes above 230. Two, I am going to look at various expiration dates because I'll take time on this trade. If I can do this with a July or August expiration and not pay much more, remember I'm selling a put and buying a call. Those are gonna wipe themselves out, but I'm paying for that out of the money put. So that I'm buying. So I'll look at longer durations. I may not find one. This is the trade I take, and I will watch and I will decide, do I hold it to the end? Probably not. I might look at the value of my trade when it falls 50%. I will think about closing the trade. I probably won't close it if the trade's up 50%. I'll ride it and try and maximize the gain. This is my favorite trade. This one, chicken shit synthetic, ratio back spread, but beware of this little bump. Broken wind butterfly, long call. I don't like verticals, but I'll take them, especially when my confidence is hurt or buying the stock. There are a zillion other options. I'm not an options expert. I'm a stock trader, and I buy options that allow me to control more shares at lower risk with infinite upside. Define your A trade, develop tools to find them. I have, and I use all these programs here. I still love HDSI, and um, I will always have HDSI, even though I pay for it. The only thing I don't have to pay for now is Market MRI Pro. You can pay me for it. And then define your trading plan. What's your strategy? What's your entry and exit and stop? How many shares? And wash once, repeat for success. And that's it. Come to Orange County. And if you can't come live, then join and watch it online. And just to make you dizzy and make me dizzy, I'll go back to two things. If you're not in the top-down trader group, why not? It costs nothing. You stayed here the most of 3 hours. Um, why wouldn't you want the videos and not have to worry about if I posted them or not? And then the Orange County meeting. Thanks, everybody. I can't wait to push out the new version. And I hope you got some value out of today. And special thanks to Praveen, who I think has built a wonderful, wonderful tool set. And if I should, I'm not a very good salesman, am I? If you're interested in buying the tool, here's what you're going to have to do. I'll put my, you can, I have a lot of email addresses. The easiest one to remember is MDONC, MD, because I'm a doctor, oncologist, ONC at me.com. It's probably my easiest email. Email me that I'm interested. If you have bought my other tools, then if you bought my marketplace package at Wealth Charts, you got to take a picture of your CAT scanner because I don't have a list. If you bought my TradingView tools, I know who you are. If you bought my TradeStation tools, take a picture of that app, and then I will give you incremental discounts for every tool. If you don't have any of my tools, you get it for $300 off. And if you can't tell, I love to teach. I do this every couple of months, and I do closed sessions for the people that own my stuff. So um, I wish you a happy weekend, and thank you. And for those who've bought any of my stuff, it always amazes me. So thank you, and have a great day.